the last cricket match that you watched? Did you notice one thing? Did the team consist entirely of batsmen or entirely of bowlers? It can't be, right? Probably a team with only one type of cricketer might succeed in some very rare conditions. They're going to be at the risk of faltering in most other conditions depending on the type of pitch, quality of competition, weather, and so on. In the same way, a portfolio that focuses entirely or predominantly on only one asset class, like say, just debt, gold, or commodities, it may be at the risk if that asset fails to perform over a specific period of time. Are you interested in finding out how different asset classes work together in a portfolio? Join me, Sumaira Abidi, on another episode of Mind Over Money, where we undertake a journey towards financial awareness. On this episode, we talk about asset allocation, and within a portfolio has the potential to help you meet any and all your financial objectives. History has shown us that in a year when, say, equity does well, this is because the factors which are driving each asset class are so different from each other. So say in a year, gold might do well, but equities may not. Another thing is that when one asset class performs well for a year, it's quite likely that it may not do well the following year. So if we focus and concentrate our entire portfolio on just one asset class, then our portfolio will always be at the risk of underperforming and probably not meet our goals. This is what we call concentration risk. I'm sure at least once somebody would have told you not to put all your eggs in one basket, right? But, don't just take my word for it. Let's get in some data. Let's take 4 asset classes: equity, debt, gold, and cash. The time period, let's make that the last 19 years. And now, let's analyze the performance. Out of these 19 years, equity and gold earned the top spot 8 times each. So that takes care of 16 of the 19 years. And the remaining 3, debt was a top performer in 2 years, and there was even a year when it made most sense to hold cash. So as an investor, do you think you and I can predict what will do well in which year and invest only in that? It's not possible. Even the most experienced investors will tell you that trying to time the market is almost always a losing proposition. So what is the solution to avoid concentration risk? Well, the answer is asset allocation means allocating or portioning your portfolio across the different asset classes. Just like the Indian cricket team is a strong combination of batsmen, all-rounders, seamers, and spinners, asset allocation ensures that we're always well-positioned against uncertainty and that we achieve our investment objectives without putting our portfolio at the risk of underperformance by any specific asset class. And every asset class has its own advantages. Equity provides the potential for capital appreciation. Debt provides the scope for income. Gold is seen as a hedge against inflation. And cash is usually the safest since its value does not fluctuate. So how do you implement asset allocation for your portfolio? You can do it yourself, but it will need time, effort, and knowledge, which a lot of us may not have. Now, there are 2 more factors to consider here. First is the tax implication. It can differ for different asset classes. If you want to shift from equities to debt or vice versa, then for both equity and debt, long-term and short-term capital gains will be different. Second, there is the cost factor to consider because each asset class would require a different intermediary, and they'd have added costs like brokerage, security transaction tax, and so on. This is where a mutual fund makes much more sense. It can help you achieve all your objectives, keep your costs reasonably under control. So there are hybrid funds, like multi-asset allocation funds, which aim to offer investors the advantages of asset allocation and diversification by investing in multiple asset classes. So you get to invest across asset classes with just a single investment. Instead of having to invest in multiple funds for diversification, you can invest in just a single hybrid fund based on your risk profile. Some of the hybrid funds invest not only across asset classes, but also actively manage the asset allocation based on the changing market conditions, right? So they're agile in that sense. They also tend to have lower volatility because investments in different low correlated asset classes bring down the overall risk profile of the portfolio. And you can also benefit from the services of experienced fund managers and their investment teams. In fact, the fund manager of the hybrid fund is like a coach. He selects the cricket team. Before leaving for a specific tour or match, the coach will assess the match conditions, the pitch, the weather, and whatnot. And then they will come up with the right combination of players for that tour. Similar to a fund manager looking at economic conditions, global factors, earnings, and so on to decide how much to allocate to which asset class. So to wrap it up, asset allocation is an important factor to consider when you're setting up your portfolio because different asset classes perform differently over time. And it's important to manage these risks to achieve your financial goals. That's it from me on this episode of Mind Over Money. If you like this podcast and you want to be reminded of our future episodes, then do subscribe on all your favorite audio platforms and also follow the SBI Mutual Fund YouTube handle. I'm Sumaira Abidi, and I'll see you again soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.